Financial Statements Overview. 1. What are financial statements? Financial statements are formal records of a business's or individual's financial activities and position. They are used for decision-making by stakeholders like owners, investors, creditors, and managers. Key types of financial statements. 1. Balance sheet, shows assets, liabilities, and equity at a specific point in time. 2. Income statement, profit and loss statement, shows revenues, expenses, and profit over a period. 3. Cash flow statement, tracks the flow of cash in and out of the business. 4. Statement of changes in equity, reflects changes in owner's equity over a period. 2. The balance sheet. Definition and importance. The balance sheet is a snapshot of a company's financial health at a particular moment. It shows what the company owns, assets, owes, liabilities, and the owner's claims on the business, equity. Structure. 1. Assets. Current assets, cash, inventory, accounts receivable. Non-current assets, property, equipment, patents. 2. Liabilities. Current liabilities, accounts payable, short-term loans. Long-term liabilities, bonds payable, long-term loans. 3. Equity. Owner's capital, retained earnings. Example is shown here for balance sheet. Three. The income statement. Definition and importance. The income statement reflects the company's performance over a specific period. It helps stakeholders evaluate profitability and efficiency. Structure. 1. Revenue, total income from sales or services. 2. Expenses, costs incurred, such as salaries, rent, and materials. 3. Net income, revenue minus expenses, profit or loss. Example is shown here for income statement. Four. The cash flow statement. Definition and importance. Tracks the movement of cash in and out of the business. Helps assess liquidity and ability to meet short-term obligations. Structure. 1. Operating activities, cash generated from core operations, for example, sales revenue. 2. Investing activities, cash spent on or earned from investments, for example, buying equipment. 3. Financing activities, cash related to financing, for example, loans, dividends. Example is shown here cash flow statement. Five. The statement of changes in equity. Definition and importance. Explains changes in the equity section of the balance sheet over time. Useful for understanding retained earnings, new capital investments, or dividend payouts. Structure. 1. Starting equity balance. 2. Additions, net income, new capital contributions. 3. Deductions, dividends paid, withdrawals by owners. Example is shown here for the statement of changes in equity. Thanks for watching and stay tuned for more videos.